The 2009 American economic recession was the biggest and most recent real recession that we've had other than the one that we are actually going into right now. Thanks a lot, Bill Clinton. It's actually a really interesting one, and chances are that you know someone who was impacted by the 2009 recession, and you're probably being impacted by it still. I know I do, and I definitely am. Now, the price of many of our favorite cryptos has been tanking, and few analysts think that the sell-off is over. And you want to know what action you can take within your investment portfolio without having to sell and take heavy losses in the crypto that you are holding. Now, if that's you, then you're in the right place. You are tuned into the finale episode of a 4-part series that has peered into the darkest period in Americans' economic history, and you want to find out what causes these recessions, how the economy's eventually recovered, and most importantly, what assets remain resilient. And I'll be trading my knowledge and perspective for something valuable that you might have. And that is your attention and your willingness to go and share this series with your peers. So before we get into it, make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Now, let's go see how 2009 is affecting 2023. The 2009 American recession, also known as the Great Recession, officially started in December of 2007 and wrapped up in June of 2009. 2009 was a devastating economic downturn that was caused by a series of events that were like dominoes falling one after another. These events included the bursting of the housing bubble, the subprime mortgage crisis, and the collapse of the shadow banking system. Great. And the housing bubble was the first domino to fall. During the early 2000s, there was a rapid appreciation in housing prices due to an increase in demand and a shortage of available homes. This was fueled by easy credit and low interest rates, which made it easy for people to take out mortgages and buy homes, multiple homes, even if they didn't need them. However, the rate of growth was unsustainable and eventually the bubble burst. The subprime mortgage crisis was the next domino to fall. Many people who took out mortgages during the housing boom had poor credit and were considered very high risk. But not to Bill Clinton. He said, go ahead, give them 3 houses. These high-risk or subprime mortgages were still given to people despite many of the people being underqualified by a lot. As a result, many of these people defaulted on their mortgage when the housing market crashed. This led to a wave of foreclosures which further exacerbated the downturn in the housing market. Now, the collapse of the shadow banking system was obviously the final domino to fall. The shadow banking system is made up of non-traditional financial institutions such as investment banks that provide financial services outside of the traditional banking system. Those institutions had been heavily invested in mortgage-backed securities, which were securities backed by mortgage loans. Go watch The Big Short and learn about swaps. When the housing market eventually collapsed and people started defaulting on their mortgages, the value of these securities absolutely plummeted, leading to the collapse of the shadow banking system. The consequential fall of each of these dominoes kicked off one of the worst recessions in United States history. And let's be real, it affected the entire world. And during the 2009 recession, many assets sold off massively. The entire stock market was heavily impacted, with the Dow Jones Industrial Average losing 53% of its value. The housing market obviously suffered as well, with home prices falling significantly. However, some assets did perform well during the recession. And surprise, surprise, gold smacked it out of the park with 22.7% increase in price from the start date to the end date of this recession. Man, I love gold. Gold prices deviated up to 30%, but also down 14% at different times during this recession, so many traders certainly got fooled into biting the top or selling at the bottom. But overall, you can't dispute that gold has an excellent spot as a good hedged asset to protect your wealth from the economic downturns that could be happening. Government bonds did pretty well as investors now had the previous 2 recessions as strong data points to support a buying bias on US bonds working as a recession hedge. Another asset that performed well was the US dollar, which was really surprising, but appreciated in value due to the increased demand of safe haven currencies. This is the first time we see the US dollar on the list of assets to preserve wealth through a recession, and I don't think that's how it's going to be this time. This is because the other 3 recessions that I covered in the series all coincided or were straight up caused by high oil prices that sent inflation through the roof. Cash is king, or it was king, but when inflation comes into the equation, you actually lose purchasing power and wealth by just selling into the dollar and holding. 2009 was the rare exception to the last 70 years of recession data that all mostly saw high rates of inflation that punished investors who held their wealth in straight cash. The 2009 recession was eventually resolved through a combination of government intervention and economic recovery. The Federal Reserve also lowered interest rates and implemented quantitative easing, or QE. QE is a policy of printing new money to purchase securities in order to increase the money supply and stimulate the economy. The unemployment rate, which had peaked at 10% in October of 2009, began to decline and eventually returned to pre-recession levels. Whew. Now, you see why in the previous episode I mentioned that the savings and loan crisis was a bit of foreshadowing to what economists should have predicted to happen in 08 and 09. But it was in the depths of this chaotic recession that Bitcoin was born. January 3rd, 2009 was the date that the Bitcoin network came into existence when Satoshi Nakamoto mined the Genesis block. A new currency that we've all come to know and love was birthed at the depths of one of the American darkest economic moments known to man. But that isn't just it. If you take nothing else from this series, realize this. Bitcoin and all other cryptos have never been through a true economic recession. We don't know what will happen to the price of Bitcoin when the next Middle Eastern country can't export oil, or if the segment of the real estate financing industry becomes destabilized by a group of over-leveraged money managers. If there is anything certain in this world, it is that there will be more financial crises in the future that wreck the price of risk assets and send recession-proof assets like gold and bonds shooting higher. And we are currently observing how Bitcoin's price will react to recessionary economic environments, because we're right in the middle of it. I mean, so far it has not been great, to be honest. However, it is also hard to separate how much of the movement to the downside is due to the collapse of big players within the crypto industry and how much of the selling is actually people rotating into gold and bonds. And I believe that once the snakes in crypto are hunted down and removed, that the revolutionary technology known as Bitcoin and a select few other cryptos will be better than gold. But the day that Bitcoin flips gold has yet to come. Not even close, to be honest. The market cap of all crypto was a little bit more than $3 trillion at one point, and the market cap of gold was around $10 trillion. So now we arrive at the point where we pause being students of history and apply what we have learned to become agents of our own destiny. Bitcoin is the future of money, and I believe it will one day replace dollars as the most circulated currencies on the planet. But until that day, I have to assume that gold and bonds are still going to be the recession-proof assets. And I will actually wipe bonds off of the table immediately and completely because the US government has never carried a 124% debt to GDP ratio into a recession like they are right now. Congress also had an approval rating that is less than half of what it was in the first 3 recessions that we covered in this series. Remember, people like to back the winners, and America is not really on a winning footing right now, at least in my opinion. And as a result, I just don't think the bonds are going to be the move. But I could be wrong if the Fed has to increase rates well past the 5.5% and for longer than just 6 to 12 months. So that leaves gold. Now, especially if you are already holding a large crypto bag, like most people probably are, you really need to diversify to the front end of this recession. And if you're profitable, break even, or barely down on your crypto, I would even consider selling it and rotating some of that into gold. But if you bought north of 23K, then you might as well hold onto your bags and wait out the recession until the next bull run comes around. But starting today, you can start to invest in gold and see the latest portion of your wealth keep its value during this bear market. I'm just gonna be real with you. The truth is, the bottom isn't in. And it's definitely not in for stocks or real estate, so what do you think that means for crypto? And crypto is a very liquid and discretionary market for people to be in, very speculative, so where do you think people are going to be pulling their money out in order to pay their bills? First, it definitely won't be stocks, and it definitely won't be real estate. Now, is there a chance that the bottom is in? Yeah, I'll admit that there's a chance, but I would say that there's a greater chance as of now that the bottom is absolutely not in, and 10K is still in play. It is more likely that stocks and crypto have further to fall over the next 3 to 9 months. And history has shown us, even after World War II, the recession has lasted on average only 10 months. From the Dow Jones peak at just under 37K in January of 2022 to the time of this recording, it has been over 12 months. So the good news is that we were overdue for a bottom, but as we have seen in this series, no 2 recessions are the same. And with a 13 to 14 year bull run that has primed us into this, and wars that are happening all over the world, this might be a longer recession than we thought. And the biggest thing that makes this recession unique is the eye-popping amount of debt that the US is in right now. And while we can't know when the bottom will print on the charts, we can know a few signs to look for to signal that we are at the bottom. As 2023 ticks by, we want to watch for an increase in buying volume, positive earnings surprises from American corporations when assets become oversold, and when investor optimism returns. These are good indicators of when stocks are bottoming after a recession. And this will also be the time that crypto will likely swing higher. And the big indicator that you may have noticed missing from that list is inflation. Inflation is a tricky one here because it is singularly the most important indicator of our current recession's bottom, because that is what the Fed is fighting, but there's more to it. The stock market will likely bottom and be well into its recovery rally before inflation returns to 2%. But inflation running currently over 6%, as of the recording of this video at least, it could be months before the Fed stops hiking or even pivots to cutting rates in a significant way. And what have we learned is the biggest driver of recession causing inflation? Oil. The last thing to keep your eye on is energy prices, and specifically oil. If oil prices climb back to their 2-year highs, then inflation may go higher and the recession could be prolonged. Now, there's obviously a lot to consider here. And the best thing that I can say is open up brokerages that allow you to gain exposure to gold, and then tune into my live streams where I keep you up to date on all of these indicators to try to identify and buy the bottom of the crypto markets with our preserved wealth. And check out the link that I have in my description where you can go and buy gold with your crypto. And that is all that I have for this recession-based series. If you haven't watched the whole series, make sure you go watch the old videos, and make sure you watch all the new videos that'll be coming out. And make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Thank you so much for showing up to this video. I will see you in the next one. Have a good day, everyone.